Hi all, I am Sham and
Hi, Sham.
I have Kishan with me. Welcome to Free Flow.
Hi,
Um,
Sham.
and we have a guest speaker who is very fond of bling. So I have here.
Yeah, I mean, she's the star of Bling.
She'll be chiming in with her thoughts on what kind of bling she likes. Uh, and it's topical because today we're going to be discussing about gold
Yeah.
as an asset class and also what drives its value, right? Um, so I let Kishan sort of jump in and take this away from here.
Yeah.
Kishan.
So, Sham, gold, if you've read the extremely famous Warren Buffett quote, that gold has no utility. And, if someone was, staying down at Earth of, looking at humans who buy gold all the time, and who trade gold all the time, and it's had this enduring value throughout history, throughout different civilizations, gold has been always been an asset that people have, looked to. Recently, you might have read like many it's like investment thesis where given the current investment environment where you have like easy monetary policy uh, where the belief is that this easy monetary policy will lead to runaway inflation, and hence gold becomes this kind of a hedge in that dire scenario, and and in India especially, you will always have people who say, okay, should I invest in gold, and should I invest in and what's the best way to invest in gold? Should I go buy jewelry, or should I go buy gold futures, which not many people ask, but there's been some interest there as well. And I've always told them that gold, being a Warren Buffett follower of some sort, that gold is something that you should not invest in. But in the
I
last
love
few
to
years,
I'd love to hear his thoughts on Bitcoin. He hates gold. Man, he's gonna have something to say about Bitcoin, isn't he?
yeah, yeah. But in the recent few years, I've seen gold as a diversification asset. The more I read about it, and I've done some correlation between Nifty and gold, and I think it's around 0.25, 0.2 or so. Though it's positively correlated, it's not it's not fully correlated. So you do have some benefits of diversification, especially the markets are tiptoeing. Especially in like March of 2020, when Nifty fell, gold was still stable. So um, I am a big believer that you should have like a portfolio which can withstand turbulent times. And given that most ordinary investors do not have, you know, cannot be exposed to options and futures and stuff, as a hedge, gold is a interesting proposition. Or at least it's something that you can look to. And we have explored that bonds are not the safe havens that people think them to be. So then is gold that uh, that alternative safe haven where it can provide some shelter, especially during turbulent times. What do you
Right.
think?
So there are multiple angles to this. So one is obviously um, from a macro point of view, you need to bifurcate your analysis between developed markets and emerging markets. So developed markets like US, Switzerland, Europe, they have currencies and bonds that are safe havens. So when things go bad, people rush to US treasuries. They go and buy EU bonds because one thing that this whole COVID thing has resulted in is like EU joint bonds, right? So they have gone and issued bonds backed by EU, not just individual countries. So earlier it used to be, German bonds, for example, so the most sought after European bonds. So whenever there's a crisis, people go and buy those. So what happens is, you know, their bonds are completely different from emerging market bonds, where EM bonds actually cause the crisis, right? And I think a similar crisis is brewing now in India because of, not just in India, most EMs, Brazil, India, and so on and so forth, where uh, there is a bit of monetary policy adventurism that has been sort of glossed over in this whole Corona crisis, focus on Corona crisis, right? So if you look at what India is doing, there's a surge of savings. There's a huge savings surge, right? People don't have avenues to spend sitting at home. So most of that money is now sloshing about in, extremely short term, um, cheap government CASA deposits,
Right.
government bank CASA deposits. So what this has allowed the RBI to do is basically, keep selling short-term paper and buying long-term paper. They call it
Right.
OMO, right?
Yeah.
But in spite of this, there's been quite a bit of, um, stress already visible in the long, uh, on the long bonds, right? So recently we had a failed auction, and the way treasury auctions work is, if the RBI says they didn't get the yields that they were looking for, they'll just devolve it. In the sense,
Right.
the banks underwriting this, the primary banks will have to buy the bonds at the indicated yield. So, so a lot of the stresses in the long end of the curve is already happening in India, and the less said about other emerging markets, the better, because we are the better of the lot, but that doesn't mean that we are safe.
Right.
And if you add to this, what happens when things are going to get normalized,
Right.
right? So once we are through, once more than 50% of the population ends up with a vaccine and things sort of normalize, where is all this excess liquidity going to come? Going to show up, right? And you can't remove politics out of the picture, because this is going to go hand in hand with the next election cycle,
Right.
right? The return to normalcy is going to kind of coincide with the next election cycle, and the last thing that they want is a bum economy at,
When elections
just,
come.
yeah, when the elections come. So they're going to keep their foot on the pedal, right? They're going to keep doing this until inflation, sort of goes through the roof. And currently, the reason why gold has sort of fallen out of favor is because most of the people are focused on equity markets. They're looking at the booming stock markets and saying, this party will go on for a bit longer. So maybe a year, maybe 2 more years. But the problem is that right now, inflation is not a problem because there's just simply no avenues to spend money.
Right.
And most of the inflation is being already reflected in asset prices,
And,
right?
and, and it's mostly on the supply side. It's the supply constraints that's pushing inflation higher.
Right. Yeah, I mean, people know this intuitively, right? Because car manufacturers are saying they can't get their hands on IC chips.
Right.
So there's a restraint on supply as well. But once this thing clears, once the market clears, we're going to see a spike in inflation. And I mean, this is sort of my 2 cents, because people keep pointing at, collapsing monetary transmission. Like there's just no velocity, right? So in spite of central banks printing money, that has not really, it has increased the stock, but
Right.
it has not affected the flow.
Right.
So money is not flowing through the system, even though there is a big sort of dam of money in the reservoir. It's just not flowing through.
Right.
But eventually it will flow through, right, at some point. And that's when you're going to see the spike in inflation. And the worst part about this is the biggest, money printer in the world, the US Fed, uh, is probably going to come out of this unscathed, right? You're probably not going to see this problem in the US, but you'll see this problem in emerging markets. You'll see this
Right.
problem kind of explode, on our faces, at some point in the future. So, so that is the macro view. And if you want to translate this into something like that you can invest in, right? So where are um, short-term uh, uh, deposit rates? 3%, 3.5%.
Right.
SBI, right? But if you go and buy RBI sovereign, gold bonds, you get 2.5%. And if you hold these bonds till maturity, you don't pay any capital gains tax.
Right.
And the 2.5% is also, I don't think it's tax free, right? It's added to your income or something. So that is treated as like how any deposit is, interest is treated, but your end capital gains is completely free. Now compare this to the 10% capital gains tax for long-term holdings in equities,
Right.
right? So it beats that hands down from
Right.
a taxation point of view, and you get 2.5% of gravy while you wait for this transmission to occur and wait for this velocity to shoot up.
Right.
So I feel that forget about its correlation with equities, because I feel it's a false choice,
Right.
and especially because since 2007 or something,
Right.
gold has been available in ETF form, um,
Right.
in the exchanges, so it has become a financialized asset,
Right.
and like my theory is that all financialized assets eventually end up correlated to each other. Because of margining, because of cross collateralization, and
Right.
so on and so forth, you end up with the same sort of correlations. So I'm not, I don't think you have to. Gold is a great hedge, but it is a sort of cushion against central bank losing control over inflation.
Right. But then, do you believe that gold should be should be part of your portfolio? Say it's a
For
one third
Indian
of your
investors, absolutely. For Indian investors, absolutely, because historically, the Indian economy has not been kind to rupee savers. So I myself, when I came back from the US, the rupee was around 35, 40. And slowly I watched it go to 45, and then, now it's like 75 in a span of maybe in about 10 years, right? So this is like, if you just hold rupees, it's idiotic. It's just losing
definitely.
money.
Yeah.
Yeah. So you need to get rid of your rupees as soon as they come in. So you either buy equities, you either buy, any instrument that gives you, like, even like 0.5% over inflation,
Right.
get into that asset.
Right.
Don't hold rupees. I mean, yeah, sure, you should have some sort of, emergency funds, but apart from that, you should,
Don't. Yeah.
yeah.
Yeah. That's a good point, right? If you're an Indian, if you're an Indian person and you think in rupee terms, you know, you don't see as rupee as you do see it as inflation, but you don't. If you're holding a bank deposit, you don't always think about it as, oh, okay, that asset is depreciating if I'm holding a fixed deposit, and there can be times if you I'm holding, say, a 5-year fixed deposit, there'll be periods where your real return might be negative.
Right.
Right. And in that period, you're actually earning, I mean, you're losing the value of rupee. While if you just held it in gold, the while you might not get a interest payout, your gold would appreciate um, in value if inflation does increase. But then the price of gold is not decided in India, right? It's decided in the world's bullion markets.
Right. I mean, it's primarily LME driven, right?
Right.
London Metal Exchange.
Right.
So what happens there is, it works in your favor. So if you think, look, it's the value of the rupee against the dollar, inflation, and local interest rates and US interest rates, they're all intricately linked, right?
Right.
They're all part of the same equation. So if you try and manage your interest rate situation, you lose control of your exchange rate, right? Something will give to to
Right.
make balance out this equation. So gold price being set in dollars or pounds is what Indian investors should be focused on, because it preserves your dollar purchasing power.
Right.
All you need gold to do is not fall like crazy,
Right.
right? It has done so in the past.
Right.
It has fallen 20-30%, in the past. The drawdowns have been on par with what you would see in in the equity markets. But in terms of managing your purchasing power in dollars, uh, it's worth holding gold. Now, the actual kicker in this deal is that 2.5% you're going to get on top of this if you do
Right.
this gold bonds, right? So you're kind of, it gives you a sort of cushion against against a steep fall in gold prices as well. And you have to think about this through an 8-year framework. Don't think of this as a short-term trade where you're going to go in and out like James Bond. Nobody's going to notice you. No, that's not the intention behind this at
Good.
all.
Yeah.
Yeah. So,
Yeah. I think this thing about the financialization of any asset class leads to people thinking short term.
absolutely. Yeah.
Yeah. So you're right that all assets or financial assets, especially during a crisis, end up at one.
Yeah.
Yeah. Except I still believe that gold. I remember in March or so, it was pretty stable. Like compared to other asset classes, even Bitcoin had fallen while gold remained pretty steady. So I mean, gold for whatever reason still has a flight to safety. You know.
Yeah, I agree. There is a fair amount of flight to safety angle to this as well, especially when interest rates the world over are very close to zero or negative already. So at least if you buy gold in in electronic form, like where you don't have to pay storage costs, even though you're earning zero, that is still better than earning negative buying
Right.
in US treasuries or something. So it makes sense to think of it as a hedge against panic as well.
Right. And then is there a strategy where you can just invest in gold when this panic comes?
Look, that is just trying to be too smart. And I think you can combine this with other assets, and there are strategies like risk parity and
Right.
trying to minimize volatility using gold as one of the inputs.
Right.
But the problem there is, in an era of really low interest rates, most of the I would say the advantages kind of go away, right? So if you look at risk parity, right, the fundamental thing there is you're leveraging your bond like there is some leverage involved in in the low volatility assets
Right.
side of things. So if you're not going to apply that leverage, then you're left with just a basic allocation model, right, which any mom and pop investor can do. And when it comes to gold, just stick to like 10 to 15% of your portfolio, and you're going to be fine,
Right.
right? And make sure that you have dollar assets in your portfolio, whether it is S&P 500 or
Or
uh,
the Nasdaq.
yeah, Nasdaq index, whatever that is. I mean, Nasdaq, right? Nowadays is looking too frothy. I would just stick with S&P 500,
500.
good old, workhorse.
Right.
It's the least sort of risk you can take
Right.
when it comes to equities over there. So just stick to that, and as part of a broadly diversified portfolio, you're going to be fine. But the problem is that investors, they're always looking for extra juice. And I would suggest that instead of looking at specific asset classes in that situation, just look at managed futures and options as as a place where you can squeeze juice out of the fruit. So don't try to do it with gambling on asset classes,
Right.
saying, oh, maybe trying to predict, okay, maybe gold will outperform, so let me pile into gold now, 80% into gold, and then predict, okay, no, now is the time to get into emerging market equity, so let me get into Nifty 50.
Mm.
Don't try to do that. Look at it as a way of saying, okay, most of my wealth is in a solid asset allocation plan.
Right.
Okay? And then you have your 5% of your wealth that you're willing to kind of bet on some funky strategy, and managed futures will take care of that for you.
Yeah, I think so too, because but the problem with managed futures and options is that what strategy. I think most people don't have you know the ability to
Yeah. Well,
I mean, because
that
it takes a lot of like management of it, right? And then given India's regulations, it's very hard for you to even to get good advice.
right. Well, that's kind of what we do, isn't it?
I know.
So
Yeah.
we give the advice, on that side of things. So so that's what I would suggest. Investors do. Don't try to predict between asset classes. Stick to an allocation plan.
Yeah.
And managed futures. Basically, for people who don't know what managed futures is, basically it's you look at all available futures as an asset class. So you have your gold, your silver, your copper, and in India you have some specific agri commodities that are also part of these markets. Then you have your equities,
Yes.
Nifty equities. So when you and then you have your currencies. So when you combine this, all of these three assets, that are available for derivative trading, and you trade all of this as a single unit, whether you do trend following or mean reversion or on this whole bunch of baskets. That's what managed futures is. So so I would suggest people look at this as the 5% bucket that is going and doing some fantastic things on for generating alpha, and keep the rest of it in a stable asset allocation plan, of which gold is definitely 10 to 15% for Indian investors. It's you know I would not pay too much attention to US based advisors and Warren Buffett followers who keep saying, "Oh, gold is a barbaric relic," and things of that sort. It may be true for U.S. investors because their economy is different, their markets are different. But for Indian investors, the ball game is different. So focus on your playing field.
Right. Okay. I think we should do a specific thing on managed futures and options at some point in the future.
Yeah, absolutely. So I think we'll close that. Is this the last post for this year?
Yeah, it is.
All right. So we bring 2020 to a close. Discussing gold, and we should thank our viewers and listeners for staying with us for so long. We started it. We started this whole free float thing this year, and it's been a fantastic journey. We'll be doing more cool things next year. Stay tuned. Bye.
See you, everyone. Bye.